Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. Here at ADISA, we're committed to bringing you fresh insights and thought leadership on alternative investments. My name is Greg Moz. I'm your host today. I'm joined by Sam Irvani. He's the Chief Investment Officer at Waveland Energy Partners. Sam, thanks for joining us here today.
Thank you for having me, Greg.
We're going to be talking about oil and gas investing. There seems to be a shift over the last 5 years and a positive shift for people growing an interest towards oil and gas. Can you kind of walk us through what's going on with that shift?
Sure, be happy to. Particularly as it relates to the ADISA, the attendees, advisors, high net worth individuals, and the retail investor. There's definitely been a shift upward. There's been $1.4 billion of capital raised in our space. That is over 2x the amount of money that the retail investors and advisors have entrusted us in this space over the past 5 years. And the two primary reasons driving that increase in activity and energy in our space, one is better job done by sponsors, better protection of capital, better selection of geology, investments that do provide stable income and opportunities for potential growth for the investors. And the second concept is this ESG, the environmental social governance, that has been shifting in dominance in certainly the institutional space. But those two concepts, and the ESG concept tempering a little bit in the past 5 years, has really opened up opportunities for communities, for institutional investors and retail investors to recognize that taking care of the environment, social responsibility, and governance is embedded within all of us. There's a right way to do things, and the economic profile of oil and gas investments and the necessity of it to support life as we know it, it's just not going away anytime soon.
So you see a place where oil and gas and ESG get along. What about renewables and ESG's focus on that? How does that interplay going forward, do you think?
Well, oil and gas and ESG have to coexist. American oil and gas companies do a phenomenal job of protecting the landscape, of supporting the social communities within which these operating paths are effectuated. So ESG and oil and gas have to coexist. And it is in the renewable side is not going away. It's really, the way we think about it is not energy transition, it's really energy addition. It's adding renewable concepts and the ever increasing support of capital and ingenuity in other sources of energy other than crude oil and natural gas over the next 50 to 100 years. That's the key. The key is do invest in technology to identify opportunities to generate energy other than oil and gas. But what we've seen in the past 5 years is there's no clear replacement, and there probably won't be for 5+ decades. But we certainly support the continued investment in other sources of energy as the presumed decline and depletion rate of oil and gas that we're faced with undeniably. But this is a 5 to 10, really a decade concept as we're seeing it. But we certainly support renewables. They're not here to replace oil and gas, but we do support continued innovation to see if we have other sources of energy that are a better replacement for crude oil and natural gas.
That's very helpful. And when you're looking at making investments, especially investments in alternatives, you should have a longer term horizon on that. As the Chief Investment Officer there, what do you think the macro outlook is for the next decade for oil and gas?
I'll speak a little bit about the way we approach it at our firm. So as I mentioned a few minutes ago, capital preservation is a key tenet of our investment philosophy. This space has seen, and that opportunity still exists for exploratory risk. And there is an investor that wants that high return, high risk profile. We are not that sort of a private equity investor. So the concept of geologic homogeneity and geologic support from thousands of historical wells provides that capital protection for us. And we are seeing a lot of our counterparts in the space following the same tenets. That's what we all need to be doing. We need to preserve to the best of our abilities. And ultimately, these are alternative investments. There is no such thing as risk-free investments. But to the extent that we can continue to support geologies and investment models that protects to the best of our abilities the original investment capital, that continues to support more and more entrants from advisors and retail investors into our space. So we are beginning to see that shift in the past 3 to 4 years in this community. And we think that all of our counterparts are going to continue to follow those tenets in the next decade to continue to invest intelligently, avoid excessive risk, and protect the investor's capital, generate value. And we are seeing more and more support on the part of advisors to continue to deploy more and more capital to energy. We're seeing it, and we hope it continues for the next decade.
The energy infrastructure is more important than ever, so that makes a lot of sense. You know, there's a lot of jargon terms when it comes to oil and gas investing, and one of them that we commonly hear is operating versus non-op investments. Can you just unpack those definitions and the difference between those two?
The concept of operated versus non-operated assets, or non-op, is definitely a germane topic. It's been very hotly debated and discussed at this conference alone. So we began this earnest investment in non-op opportunities about 5 years ago. And the concept generally is this. You have a lot of large public and privately held energy companies in the U.S. Companies such as ConocoPhillips, Exxon, the household names. So the concept of non-op is this. It's very difficult for a small operator to compete with a large publicly held energy company, compete for the best geology, the best leasehold, the best acreage, then further down the food chain with the amount of resources it takes to effectively evaluate the engineering, the geology, the permitting, the planning of drilling $10 million horizontal wells. It's very difficult for a small operator to compete with a $30 billion energy company, which has all these elements in place. They have rigs that are in place 12 months out of the year. They have takeaway capacity. They have contracts to sell the hydrocarbons. It's just difficult to compete with that. So the non-op concept is entering that phase of the investment, acquiring minority interests in an existing unit operated by a large operator. And this is it's an investment model that is available throughout the United States. So this non-op concept is entering at the phase that the public company is about to drill the horizontal well pad. Could be 2 wells, could be 5+ wells, entering at that stage and participating as a minority investor, pari passu, heads up with the operator. You pay your bills, you pay your portion of the capital expenditures. When the wells are producing, the public operator sends you your proportionate share of revenue. It's clean, it's efficient. A lot of our counterparts are performing in a non-op fashion, and it is really an option, a very attractive option for advisors and retail investors to begin to pay more attention to.
Thank you for walking us through that. But why would these big operators, these $30 billion oil and gas companies, want smaller people to come in and own part of their wells?
It's a great question, and it's part of the nature of decades of capturing acreage in this country. And you have many, many types of owners in every single unit, whether it's the Permian in Texas, whether it's the Bakken in North Dakota. In any given unit of operating acreage, it is almost a certainty that there are multiple owners. You have the majority operator and you have numerous minority owners. So you're right. ConocoPhillips does not need a $2 million investor to come in and participate in a $50 million pad. But the concept is really capital discipline. These public companies are more focused post-pandemic on the reduction of debt. They are carrying less debt on their balance sheet and more emphasis on paying distributions to their public shareholders. And each one of these companies has a very set budget for their annual development. So when you think about the availability of capital in a given year for a publicly held oil and gas company, they have these elements to think about: their CapEx development budget, their debt repayment program, their distribution model to their investors and share buybacks, and potentially mergers and acquisition activity. So there's a very limited amount of capital, and capital discipline really suggests that when they want to go and participate or establish a $100 million pad, a lot of the minority investors are often other public companies and other large privately held. So if you are ConocoPhillips and I am Shell, you happen to be a minority investor in a Shell-operated pad. When I send you a $5 million minority non-operated participant, you as ConocoPhillips will look at your capital budgeting and say, we have to exercise discipline. We'd rather sell away this invoice opportunity to somebody else to pay the non-operated bill. This way, Conoco can focus on their own operated assets, which garners more value by Wall Street, and it helps their balance sheet value. So they divest all of their non-operated assets, make a little bit of a premium, but the capital discipline really enforces the desire to sell the non-operated positions and focus on your own operated assets.
Sounds like a good evolution and a good win-win for all parties involved.
Absolutely is.
So in wrapping up, how would you summarize the opportunities for advisors and high net worth investors in the space today?
So the advisor community is absolutely critical for what we and our counterparts are doing in this space. You have to think about it from the distinctions between endowments and pension funds, which think very institutionally, and they're more governed by ESG mandates than probably they should be. The retail investor, again, as we mentioned, they care about the environment, they care about social responsibility, they care about governance, but they also care about American energy independence. And so the advisor role in this space, paying more and more attention to the sponsors in the independent broker-dealer and RIA space to get more comfortable about performance and supporting this energy independent concept in the energy addition versus transition, and bringing those concepts and feeling more comfortable to their clients as yet another arrow in the quiver, providing yet another sliver in the pie chart. That's what we're hoping to achieve, is providing these numerous types of opportunities, all of them grounded by intelligent investing and doing our best job to protect the investor capital. And that gets the advisors more and more comfortable, bringing them in and giving the advisors and the retail investor the portion of the market that the institutional investors are so ESG hampered that they just cannot participate in. It's a win-win for all of us.
Agreed. And when it comes down to the portfolio, oil and gas investments can produce some fantastic income, and there's tax advantages. So it serves a kind of a dual purpose there.
Agreed.
So, Sam, I really appreciate you sharing these insights with us.
Greg, it was a pleasure meeting you and sitting with you. Thank you.
Yes. And thank you for watching another episode of Focus on Alternatives. Again, for more educational content, please visit adisa.org, and we'll see you at the next episode.